Let's start with the standard playbook. You work hard, get paid, and lock those savings away in a bank. It feels secure. But there is a serious flaw in this logic. Money sitting completely idle in a savings account does not hold its value over time. This chart plots inflation's steady 3% upward trajectory, the invisible rate making everything more expensive. Compare that to a standard bank savings account, which practically flatlines. Look at this expanding gap between rising costs and stagnant savings. Your bank isn't actually letting those deposits sit lonely in a vault either. They are actively taking your money and investing it into businesses, real estate, and infrastructure to generate their own profits. This leaves you with a stark mathematical reality. If you choose not to invest your capital, you are opting into a slow, guaranteed loss of your purchasing power. Playing it safe by doing nothing means you lose by default. Finding a way to outpace inflation is a mandatory requirement for financial survival. So why do most people hesitate? Because making the jump from saving to investing feels like stepping onto a battlefield. We have been culturally conditioned to view the stock market through the lens of active investing. This is the exhausting process of endlessly researching corporate bank statements, analyzing market trends, and trying to pick individual winning stocks. When you buy a single stock, your entire investment is tied to one specific company. If their product fails or a cultural trend shifts, your portfolio takes a direct hit. You could look toward physical assets instead, but those carry high barriers to entry. Real estate requires huge upfront capital, constant maintenance, and it locks your money away in property that you can't easily sell in an emergency. You could also try trading high-risk commodities like oil. But these markets are rigid, highly susceptible to global supply chain disruptions, and require specialized knowledge to navigate. The psychological toll of playing this game manually is brutal. It requires you to stare at charts until 6 a.m., endure massive stress, and perfectly time market dips. The biggest barrier keeping people from building wealth is the false belief that succeeding in the market requires you to surrender all your free time and mental energy to a chaotic, high-risk system. Let's scrap that entire approach. Instead, we can use a mechanical system designed to require practically zero human effort. This is passive investing. The ultimate tool for this strategy is an index fund. Think of an index fund as a single asset that bundles together tiny fractions of the top 500 companies in the market all at once. By buying into this massive bundle, you gain immediate access to the security of diversification. If one specific company fails, your total investment doesn't collapse because your money is spread evenly across the entire corporate ecosystem. You might also hear about exchange-traded funds, or ETFs. They share the same bundled structure as an index fund, but with one minor technical difference. ETF prices fluctuate minute to minute during the trading day, whereas an index fund has a single set price every day. This passive structure eliminates the need to predict the future. You don't have to guess which single company is going to win. You just have to bet that the broader economy will survive and grow. But even with a safer asset, you still face one mechanical problem. When is the exact right time to buy in? You solve this using a strategy called dollar cost averaging. This means committing to investing a fixed amount of money on a rigid, recurring schedule, completely ignoring the daily financial news. This slow, robotic consistency stands in direct contrast to how most beginners behave. They usually try to hoard their cash, waiting for the market to crash so they can try to catch the absolute bottom, or what traders call buying the dip. By sticking to a fixed buying schedule, you naturally average out your purchase price over time. You buy slightly fewer shares when the market is expensive, and you automatically scoop up more shares when prices drop. Mathematical consistency is the exact, reliable mechanism that insulates you from the destructive, chaotic swings of market volatility. There is one major psychological hurdle to the passive approach. In the short term, it is agonizingly slow and remarkably boring. This boredom pushes impatient beginners into fatal traps. They abandon their reliable index funds for volatile, get-rich-quick schemes, or they panic and sell off everything the moment the market inevitably dips. But watch what happens with extreme patience. This area chart tracks investment growth over 40 years. For 2 decades, the line crawls slowly. But as initial returns generate their own returns, that slow climb curves into a massive exponential spike in the final years. Building lasting wealth requires a lifelong psychological commitment to stop interfering with the math. So, how do you actually start? First, look at your personal budget. Find a comfortable, small amount you can spare each month without starving yourself or over-leveraging your living expenses. Then, use a standard investing app to automate the process. Schedule the recurring transfer into an index fund, turn off notifications, and simply remove the app from your daily routine. Mastering personal finance means turning the fight against inflation into an invisible background process, allowing you to build wealth simply by choosing to do nothing.